Something alarming is unfolding in the United States, and most people aren't paying attention. Billionaires are quietly unloading their stocks, carefully, to avoid triggering panic. It started with Warren Buffett, who sold off major holdings and warned that the economy was in serious trouble. Now it's Jeff Bezos, and he's not just selling any stocks. He's offloading massive chunks of Amazon, his own company, all while offering polite excuses to keep the public calm. But let's be clear. When a founder starts dumping his own shares, right after clashing with the president, that's not business as usual. That's a red flag. Something big is going on. Meanwhile, Chinese investors are also selling off and reinvesting in China. This is coming at a time when China said it will not make the mistake of relying on exporting to the US anymore. Instead, the focus is now on its local economy. This is bad news for Trump. If China stops caring about exporting to the US, how is Trump going to keep making demands on Beijing? There is a lot to talk about, so keep watching as I break it all down for you. Last week, Jeff Bezos, the founder of Amazon, sold $737 million worth of Amazon stock. This caught everyone's attention. Bezos has sold shares before, usually to fund his space company, Blue Origin, or for charity. But this sale felt different. It didn't look like part of a normal schedule. It looked like a message. Many believe Bezos is getting frustrated with the direction of the US economy. His latest move has raised serious concerns. It feels like he's losing faith in the American market, a market that helped him become one of the richest people on Earth. What are these investors seeing that the rest of us are missing? And if you think that is all he is selling, you are very mistaken, because this sale is just part of a plan made earlier this year to sell up to 25 million shares by 2026. But the timing is very suspicious. Let's be honest. When billionaires like Bezos start selling stock during economic trouble, it's usually a warning sign. And there's a bigger story here. Bezos has been in a quiet but serious battle with Donald Trump, especially over tariffs. Trump recently raised tariffs across the board, up to 145% on goods from China. This directly affected Amazon. Many of the items sold on Amazon, especially by third-party sellers, come from China. That means costs go up, profits go down, and Amazon's business takes a hit. Amazon was even thinking of showing the exact tariff amount next to each item's price on a new budget site called Haul. That move would have made it very clear to shoppers that Trump's tariffs were making things more expensive. But Trump didn't like that at all. Let's step back and look at the bigger picture. The US economy is struggling. Inflation is high. The Federal Reserve says Trump's tariffs are making it worse. They can't even cut interest rates because prices are rising so fast. And big companies like Amazon are feeling the pressure. So again, Bezos selling his shares now? Not just a coincidence. It looks like a smart move to avoid more losses. But Bezos isn't alone. Other billionaires are also pulling money out of US companies and looking overseas. Investors are losing confidence. They see the US as unstable. Too many political fights, too many new rules, too much uncertainty, and they're moving their money to safer places. This is what we've seen before. When things get bad, the richest people exit first. They sell quietly, early, and without waiting for things to get worse. And now it's happening again. This is not even the scariest part. It gets a bit more disturbing. But before we proceed, ensure you are subscribed to the channel. You really don't want to miss our updates and analysis. While the US looks unstable, China is sending a clear message. President Xi Jinping recently gave a speech saying China's future depends on domestic strength. He wants a unified national market, strong internal demand, and supply chains that can survive outside pressure. China used to depend mostly on exports, but now it's trying to become more self-sufficient. That means building its own systems, powering its own economy, and being ready if the West ever tries to cut it off. Global investors are watching, and they're interested. This isn't just talk. China is actually changing how its economy works. It's reducing messy competition, stopping price wars, and shutting down old, outdated factories. The goal is to make a better, more stable business environment. China is also trying something smart. It wants to blend its local economy with global investors. It's encouraging companies to sell to Chinese consumers too. This gives foreign investors a built-in market and reduces China's risk at the same time. This strategy is something America simply isn't offering right now. On July 1st, China announced something huge. It declared a 10% tax credit for foreign investors who reinvest profits into key Chinese industries. That means if you make money in China and put it back into things like AI, clean energy, or high-tech factories, you get a real tax break. This is not just a small bonus. Over 5 years, this kind of deal can mean a lot more money for investors. But here's the catch. You only get the credit if you invest in China's future-focused industries. Basically, China is saying, we'll reward you, but only if you help build our future. That's not just smart, it's powerful. This 10% tax credit comes with one important condition, that you must keep your investment in China for at least 5 years. If you leave early, you lose the benefit. China is doing this to attract serious long-term investors, not quick traders looking to flip money overnight. They're building a financial system that stays strong even when markets shake. In comparison, the US markets often look like a casino. And when Jeff Bezos starts cashing out, that image becomes even harder to ignore. If you pay attention, you will notice that the way people think about money is changing. China's mix of government control and investor openness is starting to look attractive. Investors are tired of the US being pulled in different directions with no clear plan. Economists in the United States have said that Trump is an agent of chaos. His economic plans are making investors scared of what could happen next. This isn't about politics, it's about making money. China is offering reliable policies, fewer surprises, tax benefits, and the biggest consumer market in the world. If you care about profits, it's hard to say no. Here's what the numbers say. Over 24,000 new foreign-backed companies were registered in China in just 5 months, up 10.4% compared to last year. These aren't just paper companies. Many are real firms with real plans and real money coming in. Foreign investment in China's e-commerce services jumped 146% year over year. That's a huge leap. Why is this happening? Simple. China is ahead when it comes to online payments, delivery systems, and AI-powered shopping data. In fact, China has done such a good job building its digital economy that some investors say the return on investment is now better than Silicon Valley. Think about that. The West created online shopping, but China might be the one that perfected it. Of course, China's model isn't without its challenges. Concerns about censorship, government intervention, and rising corporate debt still worry some investors. But it's not just online shopping. Investment in aerospace jumped 75%. In chemical pharmaceuticals, it rose 59%, and high-tech factories are booming. This is not a one-industry story. This is a full-scale shift. Money is flowing into the engines of China's future. Batteries, engines, robotics, AI, electric cars, all built on local money and foreign investment combined. And those investors are locking in long-term positions. On the other hand, the World Bank just gave a serious warning that the US economy is slowing down fast, and the rest of the world could be next. No thanks to the aggressive policies from the Trump administration. In 2025, the US is expected to grow only 1.4%, which is half of what it grew in 2024 when it achieved a 2.8% growth. The reason is that President Trump's rising tariffs are hurting trade and slowing down economies everywhere. If the US pushes forward with even more tariffs in July, as it has planned, things could get worse. The World Bank says if tariffs go up another 10 percentage points, global economic growth could fall to just 1.8% in 2025 and 2% in 2026. That would be a serious drop. Trade would slow down, business confidence would crash, and global financial markets could be hit hard. The World Bank's chief economist, Indermit Gill, said clearly, "Global growth prospects have gotten worse. If there's no quick change, people's living standards could suffer deeply. In simple terms, if these tariffs continue, they could hurt jobs, incomes, and businesses around the world." And it's not just the US feeling the pain. The World Bank lowered its growth forecasts for many countries, like Japan, India, and the Eurozone. Because of the trade war. The countries that would be hurt the most are those that do the most trade with the United States. The worst hit is Mexico. Its growth in 2025 is now expected to be just 1.5%, down from 3% projected last November. Worryingly, this slowdown is also hurting developing countries. Many of these countries depend on exports like oil, minerals, and food. But with Trump's tariffs hurting trade, global demand for these products has dropped and prices have fallen. That means poorer countries are getting even poorer. Gill even said, "Outside of Asia, we're not seeing living standards improve. The developing world is becoming a development-free zone." Even though the White House says the warnings from groups like the World Bank and OECD are overblown, more and more experts are agreeing that Trump's tariff policy is causing real damage. The OECD also warned days ago that U.S. growth could slow to 1.6% this year, and inflation could reach 4% because of the tariffs. The World Bank did say Trump is right about one thing. The U.S. used to face higher tariffs from other countries than it charged them. But they also said the solution isn't to raise U.S. tariffs. It's to work with other countries to lower everyone's tariffs and fix the system together. In fact, the World Bank said if tariffs were cut in half, the global economy would grow a little faster in 2025 and 2026. But instead of cooperation, we're seeing more fights over trade rules, taxes, and subsidies. So what happens now? If the new tariffs go into effect in July, the damage could be deep and long-lasting, not just for the US, but for the entire world. As if things weren't already bad, even some of America's closest allies, like the United Kingdom, South Korea, Germany, and Japan, are now pouring more money into China. And this isn't just symbolic. Japanese investment is up 70%. The UK has increased its share by 61%, South Korea by 10%, and Germany by 7%. These countries aren't shifting toward China because of shared values. They're following the money. And they're doing it despite growing tensions between Beijing and Washington. This trend suggests something much deeper than simple economic cooperation. These nations are not just doing business with China. They are becoming more financially dependent on it. That kind of economic interdependence usually brings political consequences. What we are seeing is the early stage of a realignment. Countries that once firmly stood with the US are beginning to act in their own economic interests, even if that means getting closer to Beijing. The so-called economic Iron Curtain that once divided the West from China is now showing cracks. And those cracks are forming not on China's side, but on the Western side. Inside China, the mood is different. While American markets are caught in political drama and regulatory uncertainty, Chinese financial markets are buzzing with activity. In June 2025 alone, 147 Chinese companies applied to go public, a massive jump from the usual pace of fewer than 15 applications per month earlier in the year. These companies aren't waiting. They're charging ahead because they believe the market is strong, stable, and full of opportunity. In other words, they're confident. And that confidence is shared by foreign investors who now see Chinese exchanges as better places to invest their capital. Hong Kong, once seen as just a side player, has become a new hotspot for major global IPOs. In March, BYD Semiconductor, a key Chinese chip maker, raised $5.5 billion through the Shenzhen exchange, joining a wave of record-breaking listings across China and Hong Kong. Wall Street is now losing access to some of the world's most valuable stock offerings, and the money is moving fast from west to east. If the United States doesn't change course soon, it won't just lose investment. It will lose its position as the world's financial leader. And once that status is gone, getting it back may be impossible. Remember to subscribe to the channel for more critical updates on global markets and power shifts.